Hello and welcome to this fingraphs.com podcast on Dukascopy TV. Today we're going to look at a cross-asset view with the perspective of the steepening that has been taking place over the last few weeks. This steepening was initiated with the anticipations of a blue wave pre the election, and then with Mr. Biden gaining the status of a president-elect, and finally over the last few days with the announcement of a COVID vaccine which could be effective to up to 90%. To do this analysis, we will use our fingraphs.com platform. And first is a mosaic, which is a cross-asset mosaic with the many S&P future, the euro, US dollar, treasury notes, and gold on a daily basis for the perspective over the next few months and on an hourly basis for the perspective over the next few weeks. What we could say is that all these assets have been benefiting since March from the strong monetary stimulus by central banks, and we could all see the strong rally for the many S&P future into September, for the euro into August, for the treasury notes into early August, and for gold into early August. All have been pretty much consolidating since, but it's interesting to note that over the last few days, and especially with the Pfizer announcement, we are seeing some divergences which correspond to the steepening trade. So we can see the many S&P future continuing higher. Euro dollar, which had a strong bounce, is consolidating a bit, but is still in an uptrend, while treasury notes have been falling quite aggressively along with gold. Our view is that these first two assets pretty much topped out in September, and their consolidation range is probably not finished and could extend another month or so into late November, early December, which would mean probably a more risk-off environment. So we would probably warn on the aggressiveness of this breakout and would probably expect some retracement on the S&P 500. While the treasury notes and gold, which had actually topped earlier and in August, may be pretty much finishing the consolidation period we had expected. There's a bit more risk here on treasuries, but we're pretty much there on gold and could start to resume higher towards mid-November and into late November. So this would mean that we'd probably have a more risk-off environment over the next few weeks, and the steepening trade could probably settle a bit and start to reverse. Now let's look at the different assets individually. So first with the many S&P future, what we could see is that we're still in a strong uptrend, and we believe it probably extends into the higher 3,000s into next spring. On a daily basis, we're in a consolidation range, which could still see a further leg down. Our targets are showing that it could make it down to 3,050, 60. We think that's aggressive. We'll probably expect previous support around 3,200, 3,300 to hold. We could also see that it is quite exaggerated at the moment, so that would justify some correction. Shorter term, the rally may linger on slightly longer, but at some point we believe it will start reversing. Looking into the euro-US dollar, we believe that following 2 years of consolidation, we are now in a strong breakout case to the upside in a new uptrend, and this follows most cyclical assets. There's still quite some bit of leeway until we reach the overbought zone on a long-term basis, and we would expect some work over the next few weeks, but that at some point early next year we do make it above 120 again and possibly challenge the 2018 highs around 124, 125. If we look at the daily, we're in a consolidation range here. We had the exaggeration here in August. The consolidation doesn't seem quite finished. Upper end of our corrective targets around 115, which we believe we could probably retest down over the next few weeks. And shorter term, we are still in an uptrend, but it seems to be starting to mark pace and could start to roll over again. Looking at treasury notes, very strong uptrends, especially for the 150 basis points cut in March. We don't think it's finished, and we think it probably extends higher into next spring. The upside potential is probably limited, more of a kind of a distribution zone that we will probably see over the next few months, especially that the risk index is already quite extended. The consolidation that we're seeing is pretty much finished in terms of time, in terms of scope. We may see maybe a few more days of retracement, perhaps in the likes of 1 to 1.5%, but we then believe that we'll find support and start moving higher into year end and next spring. And shorter term, yes, it doesn't seem quite over yet, but it's getting quite extended, so we would expect some support to be found soon. Finally, looking at gold, Also still a very strong uptrend. We don't think it's quite over yet. Our impulsive targets have been reached, but we do think that our impulsive extended targets could be achieved around 2,300 over the next few quarters, and the risk index still has some leeway to the upside. The daily is consolidating. That consolidation is probably coming to an end. We still feel that the low 1800s will offer very strong support, and at some point over the next few weeks believe that we should be in a resume uptrend situation. Shorter term, buying the dips today is probably a bit too early because we're still in a downtrend, and the risk index is not quite oversold yet, but it's a question of days in our view before gold resumes its uptrend. Thank you very much for your attention, and we wish you a very good week in trading.